I think the first book I ever read was One Up on Wall Street by Peter Lynch. Yeah, so that's pretty common. I'm pretty sure of you've heard of that book.
Yeah.
So that really, before I picked up that book, I knew nothing about investing, right? So I didn't know what a stock is. Why would a stock price go up? Why would a stock price go down? What's the stock market? So that book really gave me the basics, and from then, and taught me like what to look out for in a company. And why a stock price goes up and how you can make money in the stock market. So that gave me a good fundamental grasp of the stock market, of investing in the stock market. So yeah, that's by Peter Lynch, and he's one of the investing greats.
Before we begin the podcast, have you gotten your free ebook? It's called the Build a Six-Figure Portfolio Guidebook. Now, inside it, we share with you the tips and tricks to bring your stock investing skills to the next level. The best part, it's only 10 pages long and it's totally free. Whether you're on Spotify or YouTube, the link to download is in the description, or you can go to www.firl.co/FREE or www.firl.co/free.
Hello, and good day, everyone. Welcome back to the FIRL Podcast, best place for long-term stock investors. MJ, we have a doctor in the house today, MJ.
Yeah, I mean, this was... is this the first doctor we're having? Let me think.
I think so. I really think so. But this doctor right now, he doesn't dissect any parts of your body. He's dissecting stocks, actually. So
that's right.
Yeah,
that's right.
So today we have a very special guest, as all our guests, and he's down south. And one day we definitely have to go and visit the gang, Kairos gang down south.
Yeah, for sure. Jerry and Serging and the likes. Yep.
That's right. And it is my pleasure to introduce, shall I call him Dr. Jeremy Chia? I think you've relinquished that doctor's title already, is it, Jeremy?
Yeah, you don't have to call me doctor anymore.
Okay.
So, Jeremy, welcome to our podcast.
Yeah, thank you. Thank you for having me.
Yeah.
Hello.
And probably I'll dive straight into it. And Jeremy has a very interesting past, but before we start into his medical line, I would like to know what is a 15-year-old Jeremy like. Tell me a little bit more about a 15-year-old Jeremy. I know I saw soccer, I saw table tennis, so probably start from there, and then into other parts of your life at 15.
Yeah, so probably a very, very typical kind of childhood, growing up in Singapore. Going to school, playing football after school, and in Singapore everybody does what they call a co-curricular activity. Yeah, so CCA. So I did table tennis, as you mentioned. And in JC I did kayaking, and I was also in the uniform group in secondary school, NCCC, and so spent my time playing a lot of sports, going out with friends. I had a pretty fun childhood, I would say.
Okay. Why the love for soccer? I know maybe uniform bodies and all that was probably to score the points. We all need the points to get into uni. But I mean, between the sports that you play, which one was you felt most passionate about? I assume soccer, but correct me if I'm wrong.
Yeah, so soccer was just something I did on the side. CCA was table tennis. I was better in table tennis. Soccer, I was, everybody loves to play soccer, so it was just something that everybody in Singapore loves it. It's like,
I see.
Yeah,
I see.
Table tennis, I picked it up like when I went to I think resorts. I think it was Rasa Sentosa in Sentosa, and they had a table tennis table there. Started playing with my brother, and I really loved the sport. So I just joined the CCA in primary school.
I see.
Managed to get into the team. Yeah, I caught a bug, table tennis bug, and then started playing from there.
I see. Yeah. What made you choose medicine to study?
Yeah, so after JC, I went to army. So after JC, I really didn't know what I wanted to do. Like I guess most people would be familiar with that. I mean, people would probably take a generic degree if they didn't know what to do. But my parents were thinking that like kind of thought that medicine would be a good fit for me, and being a young kid at the time and not knowing what to do, I just kind of followed the advice. And my brother was doing medicine as well. So my brother's 1 year older than me. He was like first year med school in Perth. So I guess I just decided, okay, maybe let's give that a go. It was fun. Yeah, it was fun while I studied it. I enjoyed my time in Australia. So I spent 6 years studying medicine in Australia. Met a lot of new friends. Had a great time in Australia. And learned about all the living overseas and also, I mean, the subjects itself in the course were quite interesting. So it's quite broad as well. You learn about, I mean, not just anatomy, but basically everything about management and everything about medicine. But after I graduated, I didn't want to. I wanted to try something else. Okay, I had a lot of friends who were doing other things. Traveling the world and all sorts of things. So I want to try something else. So I decided to do an internship in a hedge fund. Yeah, so all my med friends went to do an internship in the hospital. So I did a houseman. They did a housemanship in the hospital. I did my internship in a hedge fund.
Do they allow that in school?
No, it's not. I had to apply it for myself. So it wasn't So the housemanship is a 1 year course. Right? 1 year thing for you to practice in hospital before you can get your license, your full license. I didn't even do that. So after I got my degree, I just straight out went to a hedge fund to do an internship. And then, and then so my whole career changed from that.
I see. Were you interested in investing prior to applying to the hedge fund? Where did you catch the bug of investing in finance, actually?
Probably at the, after I came out, after medicine, I was like, what do I want to do? So I was thinking, my dad used to be an investment banker as well. So, I mean, he did talk about investing and also a little bit of these things. But I didn't catch the investing bug in uni. So it was only after I came out, I was thinking, I want to try something else. So I went to a hedge fund. And before that, I started reading up books on investing. And from that hedge fund and from preparing to go into the internship in the hedge fund, that's when I really caught the investing bug, as you can call it, yeah.
I'm just curious, what was the interview process like when you were at the hedge fund, right? Did they ask you why are you here? Did they say?
Okay, I was kind of lucky, I had to admit. So the hedge fund manager is actually my next door neighbor in Singapore. So I went through the normal HR process. I wrote an email in but he kind of knew me. So even though he knew that I was still fresh and still didn't know much about investing, he said, yeah, why not just come and learn for 3 months? It was not a long internship. It was just a short 3 month stint. He was happy to go there, go to his fund and coach me in a sense. Yeah. It's a small fund. I mean, they manage quite a sum of money. So I think but the team is relatively small, about 5 or 6 investment analysts there. So it was quite a good environment to bounce ideas and learn from them.
I see. What was your first book that you picked up? Or maybe rather than the first book, what was the book among all the books that you read about investing that really, felt that it was more insightful than the rest? I'm not belittling the other books, but, just one book that, kind of
Yeah, I read a few books. I think the first book I ever read was One Up on Wall Street by Peter Lynch. Yeah, so that's pretty common. I'm pretty sure of you've heard of that book.
Yeah.
So that really, before I picked up that book, I knew nothing about investing, right? So I didn't know what a stock is. Why would a stock price go up? Why would a stock price go down? What's a stock market? So that book really gave me the basics. And from then, and taught me what to look out for in a company, and why a stock price goes up, and how you can make money in the stock market. So that gave me a good fundamental grasp of the stock market, of investing in the stock market. So yeah, that's by Peter Lynch, and he's one of the investing greats, right? So I also picked up Common Stocks and Common Profits by Philip Fisher. Right? Yeah, that was more about it's running the similar theme about how to pick stocks, growth investing. So I think these two books really shaped my investing philosophy. If I picked up some trading book, maybe I would have thought about trading in the short-term way. But because I've read these books, I think about trading, or I think about investing in stocks as a very long-term, and eventually the stock price will move towards the business fundamentals or the earnings per share.
I see.
Yeah.
It was quite surprising that you mentioned that your dad was actually into investment banking, but I trust that it was you and your brother, just the two of you, is it?
I have a sister as well, and she's also doing medicine now.
Okay. So you see, dad being investment banker, mom, I'm guessing, was taking care of the family.
She was an accountant for a while, but worked in a bank. So she did accountancy, worked in a bank, and yeah, she quit her job, I think, when we were pretty young.
Yeah. So both parents in finance, but all three kids end up in medicine. Is that by coincidence?
I think like my dad did accounting, but ended up in investment banking. But maybe he always wanted to be a doctor, so it kind of pushed us into that path. Yeah.
I see.
Not pushed us but more encouraged us to try to see whether we like that. We like the medical path.
I see. So when you got on board this investing bug, did you hey Pa, I don't think I want to be a doctor.
Yeah, now was the response,
with your how was the response?
I would say so the response at the start was not like they were very happy about it. They wanted me to, because I studied 6 years in med school. It's not cheap. So my parents pay for me for my degree, right? So they wanted me to practice a little bit more. And of course, it wasn't like investing would not be an immediate success. It's a very, it would be hard for me to get into a proper job investing. I was lucky to get an internship in a hedge fund, but after that, I couldn't secure a long-term job in a hedge fund for a couple of years, right? So before I started writing for the Motley Fool and all that. So yeah, there's a lot of uncertainty around when changing careers. So from something that I would be pretty comfortable with. Career in medicine have been pretty comfortable financially. But yeah, so I think that they were definitely concerned. And also, it kind of wasted their money in the 6-year course, right? So I could easily have done a business degree and be more prepared for the field that I wanted to go into, investing. Or even an accounting degree would have better prepared me than medicine. But but over time, I think, and with some luck, and I managed to meet the right people, and now so now me and Serging, I think he's come on this podcast before. We've set up a fund together, and we pretty. Hopefully we are set for a long term. To build a good fund for our investors and for our own careers. Yeah.
Great. Did you after your dad, you won him over, said this is the path that you want to choose? They say, hey, now since you've got years and tons of experience in investment banking, do you try to get him to impart that experience to you in a way?
So we do chat about investing. But he's more of investment banking. He did a lot of M&A. I think a lot of deals and all that. So not so much equity analyst or so it's quite different fields. But he also likes to delve into equity investing and read annual reports. So
I see.
Yeah.
Did that rub off you when you were young, or and also when did you start reading the books? Was it during your medicine days or slightly later, or when?
Yeah, so after medicine, before I did my internship, I started picking up on investing. So that was maybe when I was 25. So I'm not one of those like Warren Buffett started at 12 years old guys. I started much later.
And so there was one part of your CV that I couldn't quite figure out, which was, after you did that internship, you became a project manager and worked on some discount memberships and raised funds. Yeah. So what was that about, actually, if you don't mind divulging?
Yeah, I started this. Have you heard of The Entertainer?
Sorry, enlighten me.
Yeah. So it's a bit like a membership where you buy a year membership and you get discounts at like 100 or 200 different cafes and restaurants.
Okay.
So we tried to set that up in Singapore. I mean, it went okay for 1 or 2 years. Then we decided it's just too much effort. So then I started to write for the Motley Fool. Yeah.
I see.
Yeah.
How hard do you had to knock to get on the Motley Fool? I'm guessing that time David Kuo was already there, right?
Yeah, David Kuo was there. They were writing. They were looking for content creators for their website. And I was already into investing, and I was looking very much into the Singapore stock market at that time, which was their focus. So Surging was writing for them already, and he had said, well, why not you just email them? They're looking for some people to write for them. So I emailed them, gave them some sample copies of what I've been writing, and some of my thoughts on investing, and then I set up a chat with David Kuo, and it was a pretty straightforward process. I mean, if they didn't like my work, they can like easily just ask me to edit it, or so. So I think they were pretty nice about it, and
I see,
and just let me into the team.
I see. When you were at the Motley Fool, did it change a bit of the perception about, because you read Lynch, you read Fisher, right? And obviously a little bit more of the classics. Did it kind of like evolve your investment philosophy, and did it shape a new way of looking at things? And most importantly, before even that, how on earth do you meet Surging? So I'm guessing that Surging actually opened the door, helped you open the door to Motley Fool. How do you bump into Surging in the first place, actually?
So I know Surging since I was maybe about 17 years old. So Surging was I had a good friend from my secondary school who became Surging's classmate in JC, in junior college.
I see.
So when I hang out with him, he brings, like, Surging will come and or like I'll hang out with their whole class sometimes. So I got to know Surging, and we play football together. We play like Dota. I don't know if you.
Yeah. MJ plays Dota quite a bit.
Last time.
So that's how I got to know Surging, and he's the one who kind of like brought me into Motley Fool.
Great.
Yeah. And your second question about Motley Fool, how did it evolve my way of thinking? I think I wouldn't say that Fisher or Peter Lynch or Motley Fool, David Gardner, Tom Gardner has very different ways of investing, but the main principle of investing is still the same, right? That a stock price will follow the earnings per share or the free cash flow per share over the long term. So all three of them share the same principles, and that investing philosophy, I think in the end kind of forms the investing decisions. The Motley Fool is more like Peter Lynch invests in a very wide basket of stocks. So he's highly diversified, invests like 1,000 stocks at a time, or up to 1,000 stocks maybe at a time. Motley Fool also has quite a wide basket, but they don't invest. They tell you to they advise retail investors to hold up to like 30 stocks. So I think the key thing is that you have to be comfortable with your style of investing, but the ultimate principle behind investing still stays the same.
Because it's quite interesting, because certain investors have different styles, different portfolio strategies, which we will get to later. But I Motley Fool is in a way, in my opinion, kind of like pioneered the way of looking at valuations very, very differently. Compared to the past lah, that the previous investors are. So I don't know. Are you? There's always this debate about value versus growth and all that kind of thing. What are your thoughts about this term? The differentiation between value versus growth kind of investor style.
Yeah, I think Warren Buffett is the one who said that value and growth are not two separate things. They are tied at the hip, right?
Correct.
So, when you look at a value of a company, you have to take into account its growth. But there are two different brackets of investing. One is value investing, one is growth investing. Growth investing is investing in companies that are growing very quickly. And the valuation from a trailing 12-month perspective looks very high, right? Whereas value investing is investing in a company that may not be growing so quickly, but from a value perspective, from a PE ratio kind of perspective, is trading at a very low multiple, or price to book ratio is trading at a very low multiple. So I think there are pros and cons of investing in both sides. So when you invest in value investing, you're kind of wanting that the investment will, or the valuation multiple will expand towards the mean. So towards the what they call so we'll mean revert. Yeah. So then you have, after mean reverts, you need to exit the company and try to find another low multiple company. Whereas growth investing is about investing in a company that can keep on growing and growing and growing and grow into its multiple, basically. To me, I like growth investing. I like to invest in true compounders, companies that, and from a trailing perspective, sometimes growth investing can look quite optically, it looks very expensive. But companies that can grow for long sustainable periods of time, and a very durable growth, can actually grow into that valuation over time.
I see.
So I would say that I'm open to both styles, but I'm more inclined towards the growth. And I think that value and growth are kind of conjoined twins. Conjoined twins in a sense.
Yeah. MJ and I, we have a view of it's just a marketing hype that a lot of people just kind of dilute the name, dilute the terms actually in a way.
Value is based on trailing multiples and growth is based on
I think it doesn't help that everything is purely quantitatively defined. So, value is, they call it factor investing, right? Low PE, low price to book, things like that, low compared to cash. But even if you talk to Buffett, he wouldn't define his way of so-called value investing strictly that way as well, right?
And nowadays, if you look at book values, a lot of the values are not captured in the balance sheet.
Yeah.
So most companies are trading at well above the price to books. So accounting statements do not take into account customer value or things that you have spent marketing dollar to. It's expense away, but it's not recorded in the balance sheet. So So I think
I'm going to pick off some of your old articles that you've written, and hopefully, don't worry, I'm pretty sure since you wrote it, it's still pretty fresh off your mind. One of the earlier articles that you wrote was with regards to REIT, and maybe I'll start off with a bigger picture, right? My guess is the fund you run has a global mandate, and probably I start off with your journey as an investor. If I'm not mistaken, you started off focused onto the Singaporean market, but probably where are your the direction of your fund? Is there a big difference in the geographical dispersion of where you invest now? Is that a key criteria, or you just have a global screen to say, hey, anything that fits into this criteria should be on the portfolio? Maybe you start with that.
Yeah. So starting with the fund, right now our fund is a global mandate. We don't have a particular weighting for each country. We just pick stocks that fit into our investing framework. And we think are good stocks to own over many years, what we define as compounders. Doesn't matter where they're listed, but typically we want them to be listed in a country with good rule of law and strong, regulations in place. But concentration limits, there are no concentration limits. So right now our fund is mostly invested in stocks that are listed in the US. About about more than 70%. So about 80%, I think, are listed in the US, and we have some stocks that are listed in Hong Kong, some stocks that are listed in the UK, and some in like one stock that's listed in Norway. So, but we don't like particularly say just because we are global mandate, we need to have stocks all over the world. We just have a global mandate that allows us to pick and choose where we want to invest at that point of time and where the good investment. Where the good companies are, and it just so happens that if they're all in the US, so be it. We'll just invest all in the US. If they're all, if it's 80% in the US and 20% is in Asia, we'll do that, right? Or I mean, based on our criteria, what we think is the best for the fund, what we think can give us the best returns. There's no like we have to invest at least 10% in Asia. There's no we don't set that kind of limits for us.
Great. I mean, you started off in Singapore. And maybe let's dive into that angle first. Where do you think the struggles for the Singaporean capital market is? Is it because of the size in which you can grow through, the total addressable market that you can address? That's why somehow or rather you screen, and then globally somehow or rather 80% seems to be concentrated in the US. Is that the problem? I'm pretty sure your home market, you're very familiar. You know, you grew up in Singapore. Obviously, you studied in Australia, but what do you think are the limitations, or is there any limitations to the Singapore listed equities right now?
Yeah, I think there are. Singapore is about, I mean, if you look at it from a global perspective, Singapore is a very tiny market. Right? So it's just being a small country, a small market, there's going to be just fewer opportunities here. There's only like, I think 700 listed companies here, and most of them are like tiny market caps. And very little tech stocks in the Singapore market, a lot of REITs, a lot of finance, a lot of energy stocks. So, I mean, from an investor's perspective, if you're just going to, and you have a global mandate, if you're looking around the world, naturally, because Singapore is small, there'll be fewer opportunities here. And at the same time, like even the companies that are headquartered and operate in Singapore do not want to list in Singapore. Also because the capital markets are not that kind to companies listed here, so they don't get very good valuations. So when they do IPO, they cannot raise they won't get a good valuation to raise money at. So then that becomes a chicken and egg problem. So in the US, it's much more easier to market in the US and to raise more capital at better valuations. So you see like companies like Grab, deciding to list in the Grab through a SPAC, and decide to go through the US market. They get more exposure. They get better valuations, and they can raise more money in the US market. So maybe it's a chicken and egg problem. So like, if there are more investors here, more companies will list here, and then there'll be more investors here, and so it's like a network effect kind of. So Singapore just doesn't have that strong a network effect, whereas US has, and US has. And naturally, we have a lot of companies that decide to list there. And it's not just Singapore companies. There are a lot of companies that operate outside of the US but want to list in the US as well. So, that's
yeah.
MJ,
we will know right? There's Grab and Kasem on our side as well, who prefer to be there. But I have to ask, one thing that struck me, like I know it's a big debate in Singapore. A lot of people ask your leaders, right, why can't we have a leader, like a world beater kind of company, you know, like the Ubers and, you know, Airbnbs of this world. And I remember your late Prime Minister, right, Prime Minister Lee Kuan Yew, when he was asked the question, right, he just smiled and he just said, you know, what's our largest export right now? Popiah skin, something like that. So he was making. I always remember that because it's seldom you see a leader so frank about their country's limitations, right? So I have to ask, right, like is it still popiah skin? Because it's been 10 years since the interview, if I'm not mistaken. And number two, like, yes, Singapore cannot be as big as great, but, you know, perhaps the export market, right? I remember Razer was touted to be one such company. Yeah, but I'll let you answer the first question first.
Yeah, can you hear me properly now? There's like heavy rain in my house now.
Was it? Yeah, no, it's slightly affected, but it's still hearable.
Okay.
Still hearable.
Yeah.
Okay. So Yeah, I'm not sure what is the main export now. I don't think it's
Okay.
popiah skin anymore.
Okay.
Yeah, but yeah, Singapore. I mean, we are not a country that is full of natural resources or anything like that. So, I would say that our main strength is in our human resource, being a good country with a good rule of law. So a lot of international countries come here and put their headquarters here. There is still a good economy running here, and we are strong in our energy sector as well. Um, but yeah, I think there are still limitations to what Singapore can do as a country, given how small we are. Um, we need external investors to come over here and invest to build the economy up.
Yeah.
Yeah.
Yeah. Actually, I just did a quick check. The biggest exports actually kind of mimic that of Malaysia. 20, I think probably close to 30% is actually in integrated circuits and electronics.
Right.
19% of all things, MJ, 19% is oil, petroleum, bituminous, distillates, except crude. Because, they don't have crude. So, but what they do is because they have Bukom Island and they have Jurong, so they take the crude,
And
value
refine
add,
products,
distill
right?
it, and then refine it and then exports. So
Right.
the rest are, salts, penicillin, I think the pharma industry, and then polypropylene, which is plastics, which is a byproduct of the petrochemical. Yeah. So I can't find popiah skin though.
No, I think maybe
No,
I
I know.
rephrase. It was more to do with a particular company that can export something like really big.
That size,
I think that's what
yeah.
the Prime Minister was referring to. Yeah, anyway, continue.
Yeah. So with regards to that about your global mandate and Singapore versus Asia Pac or even global, right? Could you share with us how do you even start? I mean, you talk about just the Dow Jones alone or the S&P alone is more than, the US markets is probably more than 20, 30,000 kind of listed companies. So do you start right at the top, the big mega caps, and then you screen down, or all the way from the bottoms up that you look at the small? How do you get stock idea generation? I think that's how I would.
Yeah. So I mean, globally there are thousands of stocks to look at. So it's impossible to look at everything. We stock idea generation is based solely on reading, going to listening to podcasts such as your podcast, any stock that you talk about. We're going to have a read, or like Patrick O'Shaughnessy's podcast, or it's really there's no scientific process of getting stock ideas, generating stock ideas. If we don't do screens, we don't do like a low PE ratio screens, because that will exclude a lot of the, I would say, high growth companies, good stocks that may not be may not even be earning any money at this point in time. So yeah, screens. We don't do screens. We really, the stock idea generation, there's no scientific way of doing it. We really just bounce ideas off each other, read articles, read blogs, listen podcasts, read the Edge magazine if you want or Motley Fool or whatever,
Understood. Where has been the least thought about place that you found a great stock idea, and where has been the place where you thought that you would generate you the most idea among all, but actually finds you the least idea? I hope you get the irony of that question actually.
Yeah. So, are you talking about geographically or?
Probably media wise or even geography. I know. Maybe give me an example of one place where you found a great stock that you never thought that you would find in this place. It could be like a Reddit blog on talking about some meme stocks, and they suddenly, that was a great idea there. Yeah.
Sorry to interrupt this podcast. I know it's a little bit annoying, but I want to tell you something that I think can be really helpful to you. I can tell you're really interested in the stock market and want to learn more about it so that you actually know what you're doing, especially when today things are getting more complex and complicated. That's why we came up with the Stock Investing Blueprint, or SIB. It's our signature e-learning program that teaches you how to pick the right stocks most of the time, Buy and sell it at the best possible time and manage your stock portfolio systematically. It currently has more than 10 hours of content and it's growing. You'll also be part of a group of like-minded investors that can help speed up your learning process. To hop on the program, click on the link in the description or go to learn.firl.co/courses/SIB.
So it was, I think Twitter was kind of surprising to me because Twitter, there's a lot of rubbish going on in Twitter. But surprisingly, sometimes there's good stuff out on Twitter. And this corner of Twitter that we call them, that people call FinTwit, financial Twitter. A lot of insightful people post good stuff there. Quite insightful and can be things that you don't hear about outside of the company, and they can post stuff that, like ex-employees sometimes post long threads about the company they're working in, like Amazon or whatever, and what makes them special, and there's a lot of good insights there for us. Surprising, right? Twitter, you don't expect that. Yeah. So I think that would be one avenue that we found good stuff in.
Okay. Yeah. The other one I wanted to ask is that how thriving or how vibrant is the Singapore investing community, and do they have a strong preference for equities outside of Singapore, or do you find that it's quite balanced? There are some guys that are okay to just stay in Singapore, or do you find that a majority of them are just happy to invest outside?
All the good ones are in the Kairos group, John.
I know. That's why it's a kind of a rhetorical question. But
sorry, Jeremy. Yes.
I mean, I don't know. I can't speak for the whole community here, but I mean, from what I see, I'm on I follow some Facebook investing groups and some Telegram groups and all that, and the Singapore communities, and some of them are quite knowledgeable in the Singapore space, so they do look very much into the Singapore market, especially some of the more popular counters. A lot of REITs are very popular in Singapore, I would think. But I think a lot of people in Singapore are also looking outside of Singapore to gain exposure outside of Singapore market. If they want exposure to more global companies, or companies that are more like software in nature, software as a service companies, you can't find them in Singapore. So I think there are people who are quite open, people in Singapore who are open to investing overseas. So you do get a good mix here, I think.
Great.
It's getting more popular.
Yeah, and it's a good segue because I want, as I said, I want to cover some earlier articles you wrote, and one of it was actually a few of it actually touched about REITs, and I picked up one which was entitled "Does Your REIT Manager Have Your Interests at Heart?" Maybe you want to explain a little bit more why that article was written. 2019, written December 2019. So what sparked that?
So I mean, I've been looking at the REITs for many years, right? Since I started writing for the Motley Fool, REITs were one of the big things to look at because, I don't know, we have like 40, 50 REITs in Singapore. It's a big market. So I wanted to find out whether the REIT managers were actually making decisions that benefited shareholders and unit holders. So I looked into the incentives that REIT managers were basically their remuneration packages. So I looked into how they remunerated, what sort of performance bonuses they were getting, and just compared a few of them. I can't remember exactly off my head which REITs had better packages, but basically, if you're looking at REIT managers' incentives, you need to look at for REIT managers that are not like purely incentivized based on assets under management. So that those REIT managers will say, let's raise more money now and let's buy a new property, and they will get remunerated more, right? Because their incentives are based purely on assets under management. So you need to get REIT managers that are actually incentivized based on DPU, or distribution per unit growth, rather than purely assets under management. So distribution per unit growth is something that ultimately affects unit holders. So that's the key thing I was looking at. want to find so if you're investing in REITs and you want to find managers that have your interest at heart, you have to look for these REITs that, they have a pay structure that are aligned with shareholders, not just to grow the REIT for growing sake, right?
Yeah. It's a good point that I want to segue into a bigger question, and this I think doesn't just apply to REITs, but also companies that you guys invest in. So in Singapore, it's I think relatively easy for you guys to like, hey guys, can I come and see you and just talk to you and access quality of management. In this case, how do you attribute the weightage or quality of management in your investment judgment calls or your thesis? And is it necessary that you meet up with them, or do you think that based on what you've read, analyst briefings or any social media appearances or media appearances that they have is enough for you to form a judgment call on the quality of management?
Yeah, that's a good question actually. So quality of management is I would say it's one of the key things we look at. So we are not one of those people who say, oh, this is a good business, we don't care who's managing the company. It will take care of itself. We really look at management, especially for companies that, they need to execute, they need to grow they need to grow into their valuation, especially when you're paying up for a company. You want companies that can grow, and management is one of the differentiating factors, right? So I would say the first answer to the question is that, quality of management is very important. I would say one of the things that we look at the most, actually. But it is difficult. Qualitative things are difficult to measure. I mean, you can't measure it, right? Because it's not quantitative. You really have to try to get a feel, try to understand the management. So it's good to see a company that's been managed or managed by a managing team or CEO that has been there for many years. So that will give us some comfort that he's been doing a good job. So we look at the past record. How has he been communicating with shareholders? Has he been fair to shareholders in the past? What sort of remuneration package does he have, right? So I think Charlie Munger was the one who said, show me the incentive and I'll show you the outcome, right? So if the incentive is to grow earnings per share or free cash flow per share, then the outcome with that, the management will make decisions to grow that, and that's important for the long-term value creation for shareholders. If the outcome is just to grow revenue, the management team might just be acquiring companies for no reason or be wasting capital, right? And yet they'll be incentivized, and yet they'll be growing their remuneration. So we need to look at the remuneration, what they are remunerated on. Some of them don't get any cash at all. So some of them get only stock-based compensation that vests over 3-4 years. So that's dilutive for shareholders, but for us, that gives us alignment of interest.
Yeah,
so if their stock options are given now and then based on the exercise price, and if 3 years down the road the exercise price is below the current share price, they're not going to. Or if the exercise price is above the current share price, the options are going to expire worthless, right? So so for them, it's really they want to make sure that the stock price moves up. So that's also, the alignment of interest with the shareholders, and as long as it's vests over a long term or the options are long term options, then those are that gives us some peace or some idea that the companies, the incentives program are actually aligned with shareholders, long-term shareholders. Also, we also look at other things. We look at interviews. We listen to analyst conference calls, get a feel of what they're talking about. What is their motivation? What is their I would say, what are they focused on during each call? So that gives you an idea of what's important to them. And I would say that that gives us a good idea. So interviews, but I would say that we don't actually, all this in totality, all this information put together gives us a good idea to judge management. So we actually haven't had a need to email Jeff Bezos or get to know the management team personally in that sense. So we just put together these pieces and we can kind of get an idea of how they are like. So
I know both.
If we have
sorry, yep, continue.
yeah, I mean, if we have a chance to meet them, that'll be great. But if not, I think, and we have a good feel over with the material we have online, that's sufficient for us.
I know that both you and Sir Jing actually share a lot your portfolio, at least the write-up of what's inside the portfolio. And I know it's also something like a 30 or 30 odd position portfolio. And so to your point about studying management and all that, how do you keep up with all the conference calls, all the presentations, especially when you have 30 over, right? Do both of you all like split or like, how do you guys do it?
We the two of us read all the transcripts. We don't split it up. So he reads it. We both read like the Amazon transcript for that quarter. We both read Google transcript, Alphabet transcript. I mean, it's a lot of work. But it's not. I mean, it's still manageable, right? We have about 50 companies in total. And so every quarter we have 50 reports to read, 50 transcripts to read. Over a year, that's 200, right? It's not, I mean, we can read 4 or 5 in a day. It's not really a problem. So you can finish it pretty fast. And also when we're looking at reports, because we've been following these companies for a while, there are certain key indicators that we track. And we don't look at every minute detail. We look at the key indicators which give us a good picture of the company. And that helps us to streamline the process of understanding the company's recent results. And so, I would say it's a lot of work, but it's manageable. And we still have time to look at other companies as well to generate new ideas. Hopefully, I mean,
It's great. I mean, I think it's hopefully the audience actually get away with, this. You guys are managing like 50 companies and there's like 200 reports, and you can do it even. Most of our listeners actually don't manage money on a full-time basis. So in a way, I was hoping that your encouragement, the way you do gives them encouragement that it's still possible that you can still manage. I want to appeal.
I know of retail investors who have a big portfolio. They're not full-timers, but they manage to read all the transcripts as well. So if you want to do it, you can do it.
Okay,
but if you don't want, I mean, quarterly transcripts, you can skip 1 or 2. It's okay. You can go to like half yearly. You can do it half yearly. It's still fine.
Probably related to that was in terms of in a way, I wouldn't like to assign the word for it, but a lot of your work is actually kind of like desktop. Do you actually find time to actually do what we call on the ground kind of research, or do you think it's not necessary at all? In a sense that because you guys have a global mandate, I doubt you will fly to Norway all the way just to meet one guy that you invested there, right? So how do you balance that up, or do you think it's not even necessary with the methods of your research and it's sufficient?
At the moment, there's a lot of good information online. So we do a lot of our work on the laptop and online. Sometimes we do like email management teams, and hopefully they give us a response. Sometimes they don't respond, right? But that's not a lot of most of the time we get most of the information just through our laptop. We can do a lot of research as well, like if you want to research. At one stage, I wanted to research Match Group, Tinder one. So you can do research like what is Tinder? You just take a download, see the user interface, user experience. You think, that kind of thing can be done on at home as well. So and we invested in this company called Chipotle. I invested in the company quite a few years ago, and I hadn't even tried AAA before. But looking at the finances, you can see that this is a company that is well loved by consumers. I had a chance to finally go and eat AAA, I think a couple of years ago, and it was good. I don't think you need. It's nice to know to have a feel of the company, have a feel of the products, and have a feel of what consumers say about it, and maybe get a personal chat with management. But there's a lot of good things online that you can do the research. A lot of information online that will help out. And I don't think for retail investors who have limited resources and limited time. I think it's still doable. It's still doable to invest in
Great.
global companies. Yeah.
Great. MJ, have any questions?
Yeah, actually, it's just more to the 50 stock portfolio is more like, how do you all decide how much to put in? I remember something along the line of you build it over time, so then you get more confident. Then you add a little bit, maybe 1-2%. Is that how you guys do it, or you guys do it differently?
So when we started the portfolio, we started the fund with 40 companies. These are companies we were familiar with, companies that we had confidence to grow over the long term. So Sergey is a portfolio manager. He decided to bracket them up into 4% weightage, 2.5% weightage, 2% and 1% weightages. So the weightages were based on familiarity of the company, how risk-reward ratio, so how fast these companies can grow. So some of them, like even some of the 1% companies, had very high potential, but maybe a little bit more risky in the sense that they were more young, more like we invested in Datadog at 1% weightage. Probably the thinking was that the company was still young, is just IPO'd maybe 2019. We started a fund in 2020, so it had like 6-7 months of life as a public company. There wasn't. It was growing fast. It was good. It was a decent valuation. For its growth. There was definitely a good reward potential there, but there was also risky execution risk, and the fact that it wasn't listed for a long time. So we decided to weight that one down a little bit. So a lot of that goes in the thought process of weighting the fund. And now as the fund progresses, the weightages will change based on the stock price.
Yep.
So as we allocate capital, we will take that into account, and then we don't actively manage the weightages now, but when we do add capital in, it will automatically shift the weightages a little bit. So a lot of it has no hard science about it or exact like mathematical formulas that we use, but some of that thinking goes behind the weightages of the portfolios.
Great. I'm going to move into something that MJ and I'm very sure you as well enjoy. It's about Manchester United.
Actually, I'm a Liverpool fan though.
Yeah, I know. I'm a Liverpool fan like you. The days of John Barnes, Ian Rush, the left.
Polymore, is it? Polymore.
Yeah. Yes. Those are the days. Those were the days when I was watching, right?
Yeah.
So, but actually now more focus on the economics of a football club. What I think what prompted you to write was actually Cristiano Ronaldo signing on. Obviously, MJ is a big MU fan. So, what are your thoughts about MU? And probably, I do not know whether you've done a comparison, but against the Spanish clubs, the La Ligas, the Barcas and the Real Madrid, and what do you think are the economics of football, and why do you think it's a good or why do you think it's a bad investment?
Yeah, so I wrote this article about Man U, I think last year when Ronaldo first signed for Man U. And the stock price went up, So I was watching like, what is the economics of a club, because some of you may be surprised to know that Man U is actually a listed company, and you can actually buy shares in the company if you want to have a share in the profits of Man U. So I was looking at that and realized that actually investing in a club is not really a good investment.
Nope.
Compared to some of the other companies out there that are growing very fast. So a club has a lot of expenses to pay, wages, it has to upkeep of its stadium, and its revenue streams are not certain, right? So it depends on fan base, it depends on attracting people to the stadium. It depends on viewership on TV, and it depends on whether you can even make it into a competition like the Champions League and all that.
Yep.
Yeah.
So it's very lumpy cash flows, and then they also have assets. They buy assets, which are players, right? And those players depreciate in value, and then they sell them. So unless those players can appreciate in value, then they can make some money from that investment. So I was looking at the financial statements. I would say that menu to me looked like a poor investment to make. Of course, I mean things may change, and they may be very good investors of assets in the future, or they can buy sell players. But it's a difficult environment to do a business in, especially when you have to juggle fans. You have to juggle the fan base, and you can't make them unhappy. Basically, if you make them unhappy, you try to squeeze out more profits. They are unhappy, and then you lose the fan base. You can't sell merchandise to them. So that's a very delicate situation to be in. So yeah, I think that clubs are quite a difficult business to be in. But I haven't looked into Spanish clubs. I don't think many clubs are listed. I think Spurs is listed. Man U is listed. I think Spurs are listed. But Liverpool is privately held. I don't know about the Spanish clubs. Barcelona or Real Madrid.
I'm actually looking at Barcelona's report right now while you were, describing it, and
it's one of the worst. It's actually
doesn't look pretty, man.
Yeah. I think, and they are privately held as well. So I don't.
They're held by the members actually.
They're held by the members. Okay.
Yeah. So just a quick rundown. Treasury management level, the club closed the year with 60 million euros in available cash. Gross bank debt is 533 million.
Yeah, beautiful.
So, it's 10 times the debt size is 10 times the cash they have. Revenues are very lumpy, up and down, as you said, lah. So
it's actually
it's tough business.
Yeah, it is. It's actually more of like a ego. How do I put it? What's the word? It's like a yacht, lah, right? For rich people. They own a club or things like that. That's why one team that's doing really well now is Man City, because they can essentially just fake their revenues, because the commercial revenue, right? They went from 0 to now matching some of the top clubs, because a lot of their revenue comes from first of all, they have no fans, right? Let's be honest, right? So where are they getting the commercial revenue from? And they're getting a lot from Etihad, right? Yeah. So yes, it's business, but it's really just money being pumped in from the Saudi states, the Gulf states, right? So they don't have to make money, but they're not like Liverpool. I'm sure in the old days, Liverpool, you guys had to sell just to balance the books, right? And if Man United continue to screw up some more, they may have to be in that situation as well. Because the owners, who are Americans, actually want to make a profit. They actually are banking not so much on the cash flow, but on the whole brand value that someone else, it's like it's like art or NFTs in that sense, where it's someone else who wants to buy it for more. It's a greater fool kind of theory. At least that's how I understand. Otherwise, you won't buy it based on the cash flow. It's very difficult, because every time you generate, like for example, Barcelona is the great case, right? They were so successful, I think, in the late 2000s, leading up to the early 2010s. Every time they had successful, they had to spend like another 100 million on a new player, because they need to continuously reinvest, and so that's not favorable for investors who want capital efficiency, lah. That's what I would add.
Do you amortize a player? Just curious,
you do. It's if I'm not mistaken, it's the biggest
right?
cost. It's the biggest cost for.
Yeah. Interesting. I don't know how the tax department, or how usually the amortization and depreciation is determined by either your tax accountants or the.
Actually, this one will be. I think it's the. What do you call that? Is the length of the contract, and then you also got the pay. So they front run like rental, when they depreciate rental, so to speak, and then the cost of the player, lah, which is sometimes spread over or lump sum. So they were. It's very complicated, because each deal is so complex. Many parties involved.
Correct.
Yeah.
I was just looking at the balance sheet of Barca, and their season budget is wow.
Yeah, now you know why they have to sell Messi. They have to let Messi go.
Yeah. It's insane, man. It's insane.
Yeah.
Okay.
The players
Jeremy?
are all like on the free cash flow, on the cash flow statement, they are all lumped under capital expenditure, I think.
Yeah.
Players, and then they will amortize that cost over time.
Yeah, exactly. Great. Too bad Liverpool isn't coming up anytime soon. It's like Jeremy, those were the days, when when football wasn't run on very big money, but not as big money as it is today. Yeah.
Yeah, but
So-
Liverpool's doing well now, though.
Yeah.
Yeah.
It's a tight race, quite a tight race.
Yeah.
Yes. Yeah. So coming back to stocks, and probably one thing that I really want to touch on. There's three main things I still want to touch on. First one, I think I would start with valuations, because as I earlier alluded to, when you join the Motley Fool, and the way they look at valuations, especially for growth kind of companies, are slightly different from your nets guy, your balance, just balance sheet analysis kind of valuations. So maybe could you give an example of a stock that you initially thought was a little bit valued at too high, but because you love the quality of the management, you just like, hey, maybe valuations can be adjusted in a way that I'm taking a bet right now because of the growth rate, and it turned out well, and probably one that maybe you paid too high of a valuation that it did not turn out so well.
Okay. Looking at it from our fund or from my personal portfolio. Maybe?
Either one.
Yeah.
Your best and your best one, and probably your lousiest one, regardless of whether it's a fund or your personal.
I think from a fund perspective, it's a bit short now to give it like say it didn't turn out well. But yeah, we have had some optically looking expensive stocks that we bought, like the trade desk. I think we bought at $45 a share. Now it's up to maybe, even after the real stock crash in the last couple of months, it's still up about 40-50% in a year and a half. So I mean, you see, so we don't know how that would turn out. It's still short. It's still a short time frame. But that shows that people are willing to pay up for a company that has a long-term growth potential with very durable growth advantages. In terms of company that has done badly, let me think from my personal portfolio, because that my personal portfolio, I've liquidated everything now, but I liquidated everything before we launched the fund, but I'm sure I've had some big losers out there that look cheap, but didn't do well, right? So let me think. Okay, like for example, I invested in a company called Neo Group in Singapore. Neo Group was trading at a PE ratio of about 19.
Okay.
It does so 19, right? So it does food catering in Singapore. Food catering is a highly fragmented industry in Singapore, but it was one of the top ones in Singapore, and probably the highest market share when I first purchased it in 2014 or something like that.
Okay.
Unfortunately, I mean, it looked cheap. It looked like when it was growing its top line pretty decently. I mean, it was growing like maybe 15-20% at the time. But the management team decided to take on too many things. So they decided to move into food manufacturing, low margin businesses that kind of diluted the business, and investors kind of lost confidence in the company. So I bought it at 90 cents, had to get rid of it at I think 60 cents per share. So I made quite a hefty loss on that. Considering, but the company was kind of the quality of the business was dropping because of a little bit of what Peter Lynch would call diversification, right?
Yeah.
Moving into businesses that have lower margins. Yep, the addressable market was much bigger, and if it could execute, it would be good. The absolute dollar profit could have improved, but it was too difficult of a business for them, I think. And they eventually took the company private. Maybe the founder felt that the shares were undervalued and he could do a better. Like investors were not appreciating the business enough. But yeah, it kind of goes to show that even if the company is trading at a so-called cheap valuation, if management makes decisions that investors don't like, we end up with a share price that reflects that.
Okay. Probably what would have been the stock that surprised you the most? In a way, that means you bought it, you knew there was some growth, okay, very accelerated growth. but then all of a sudden it just really just blew your mind away. It's like, you know, after like you were said, maybe in your fund, it's a little bit too short, but maybe in your personal capacity. I know for surging was Netflix.
Yeah, surgery that was a big one, right? Netflix. But unfortunately, I don't have such. I only started investing for my personal portfolio in 2014, right? So that was 7 years ago. And I started mostly in the Singapore market. So the first stock I bought actually was the one that kind of surprised me. So it was Riverstone Holdings. It's actually a company that has a dual listing, right? Dual listing in was it dual listing or no? Top Glove has dual listing, but it's Riverstone is listed in Singapore, but its operations were all in Malaysia.
Yep.
So I think within the first year, the stock quadrupled in price. Right? It's kind of a bit of a cyclical business because they depend a lot on raw materials costs and that can move up and down a lot. Commodity prices moves up and down, and then margins can improve and deprove. But I mean, overall, the business was actually moving up quite steadily. So they are building new production capacity lines. Riverstone is a very steady company. It gives a steady dividend as well. And they continuously build new production lines. I think now they're up to 10 billion. At the point when I purchased it, they had a capacity of 5 billion gloves, I think, 5 billion gloves at the time. And now they're up to 10 billion, so doubled capacity. And they're slowly, like, every few years, they're building more capacity and the world is soaking up the demand, right? Clean room gloves. They specialize in clean room gloves, and now they move into healthcare gloves. So healthcare gloves, I mean, there's a big need for it, especially during the COVID period where we saw a large spike in demand for that. I think the demand has come down a lot, but over time, I mean, rubber gloves and healthcare gloves, clean room gloves there's going to be a continued need for these gloves, and yeah, so Riverstone surprised me. It went up so fast. Of course, then it stagnated a while, and then during COVID, it went up again. So I mean, it's quite surprising the speed. You can tell. It goes to show that stock prices don't move in a straight line up. They move up suddenly, and then they stagnate, and then move up suddenly again, and then they come down and move up. So you need to be invested in long term. Like I also invested in Hourglass. Hourglass is a company that's listed in Singapore. It's a luxury watch retailer. I invested at 60 cents per share. Didn't do anything, right, for like 5 years, and in 2021 it just suddenly shot up. So yeah, I think in Singapore there's I think a lot of counters do not get a lot of attention. So sometimes they may be undervalued for long periods of time, maybe 5 years, 6 years, and also if the company is not doing anything with the capital, not returning capital to shareholders, not paying off good dividends, then no one's taking interest in the company. So Hourglass, I think it got a lot of interest last year, especially when the luxury watches had another big break again in the demand for luxury watches. So, and the company decided to also up their dividend payout, and so that also made investors take interest in the company. So yeah, that goes to show, like, you have to be patient with these companies, even though their business was growing every year, but no one took interest. So the company was just stagnating. The share price stagnating, earnings was going up, NAV per share was going up, but the share price didn't move. But it just shot up like 300% in 1 year after that.
Yeah. What was your worst kind of like, I wouldn't say a mistake, but learning? What was your biggest learning, and where was the biggest blind side of a stock that you kind of missed, either in terms of valuation or maybe bottoms up kind of research that you kind of got blindsided, and then
so when I liquidated my portfolio before starting the fund, I think some of my biggest losses were maybe two companies, ARA Asset Management and Chipotle. I actually sold Chipotle too early. Right? Yeah, so I bought Chipotle at 500 per share, or 550 per share, and I sold it at 480. So at the time, Chipotle was going through a very rough patch. They had so Chipotle, I think, just a bit of background for your listeners. Chipotle is a Mexican fast casual dining chain in America. Mostly in America. There are some outlets in UK and other parts of the world, but most of their outlets are all in the US, right? So they had an E. coli, E. coli outbreak. So that's a kind of a bacteria outbreak in one of their outlets, and then it spread to a few outlets because I think a supplier had some issue, right? And then they had another novavirus outbreak. So I think that was a viral kind of infection that spread to some of the customers as well. And for some reason, this had a very bad knock-on effect on the business. People were worried that it was dangerous to eat AAA. I think some people actually got very sick, So from having long queues in the outlets to a place where there was no queues at all, and it was almost like a ghost town. So stock price really went down. The founder, Steve Ells, was struggling. I wouldn't say struggling, but he didn't exude a lot of confidence to investors, and same-store sales were going down. They recorded their first ever quarterly loss, I think, during that time. And before that, it was always profitable. So, so I sold the company at the time, thinking like, okay, the thesis has completely changed, right? Now nobody wants to go to this AAA anymore. No one loves everybody's scared to eat in AAA. But AAA actually managed to turn his business around. So after I sold it at 480, AAA is now trading at above $1,000 a share. So the business has really taken off. So one thing, there was a few lessons, I think I wrote about this before. There's a few lessons I learned about this from this experience is that if you have a good product, right, especially for F&B, people will eventually come back. And consumers have a short-term memory and they're very forgiving, especially after you execute over another 1 or 2 years without any incident, people will forgive you, right? And customers will come back. So I think there were many other cases, like Taco Bell also had a scenario of a food scare, and they came back stronger after that. Yes, there was a period of challenges for them, but they came back stronger. And if I had given AAA a bit more time, give the management team a bit more time, there was a switch in CEO, by the way. So Steve Ells left, and I can't remember his name off my head. But he came in and he did a very good job. So
I see.
So yeah, you have to give them time to execute. And if the product is good,
yeah. Just a supplementary question to that. How long is the time? Because it could be, there's this joke among, I don't know, among Singaporean investors, but a lot of Malaysian investors, this joke that goes around in the circles is that they buy on hope, making to turn around and make a quick buck, but in the end they end up becoming long-term investors. They buy with the hope that they can flip, but in the end up to become a long-term investor. So I think the question anchors around, because it's a bottoms-up approach, how long do you give management a period for them to turn around something? So if they're on the operating table right now, what is a fair timeline for you to get them, to allow them to get their act together, put it this way?
I think it depends, right? So like for AAA, I gave them some time. I gave them a year plus, and the business was coming back, but it wasn't like as good as I hoped for. But if I waited a bit longer, it would have done a much better job. I mean, the business would have I would have seen the business skyrocket, and earnings per share would have gone up a lot, and same-store sales would have, operating margins would have skyrocketed back up to like almost peak level. So almost pre-outbreak level. So it depends. So like Neo Group, I gave them a lot of time, and they didn't do well, and they continue not to do well. So you really have to make a judgment on, and I think there's no exact science you have to read up. You have to look at it from an individual perspective, individual company perspective, and the quality of the product and the competitive advantage that they have as a product, as a business. If that's all in place, then they have a better chance of doing well. If that's not, they don't have the other competitive advantages, then maybe it'll be more challenging for them to turn the business around.
Yeah, I see.
Yeah, so
Yeah.
I think it's not an exact.
Yeah, it's subjective, lah. It's a judgment call, lah. Put it this way, lah. Yeah.
Yep.
Okay. Yeah. MG, any questions?
Yeah, I mean,
And
like
before I move on to
I mean, I know this is more for the very last question that we have planned, but just want to tease a bit about on how are you managing the emotions? Just not when all of this were happening, because I can imagine this is not something that you anticipated, and so yeah, I just want to get a sense of what it was like.
Yeah, so emotionally, of course, there will be a little bit of worry when you're looking at your stocks go down. Especially at the time, I was still a new investor. I didn't want to lose money, didn't have a lot of money. So there's definitely worry. But I think if you have a good framework in place, a good investing like checklist in place, and you are confident about your style investing, and you know that you trust the process, then that worry all goes away, and you just make decisions based on that. You make decisions based on a very analytical approach. Then you can put the emotions aside and kind of suits your own worries. So you must have that. Framework in place. If not, you're gonna worry yourself sick. Right?
You think being a doctor helped? I don't know.
I would say I would be more worried if I was a doctor, right? Because if you make a mistake, you'll be someone might die. So maybe when it comes to stock, I'm much more relaxed.
Yeah,
the
so definitely it did
the
help.
worst that can happen is you lose a bit of money, but you just try to keep calm.
Yeah.
Yeah. The CEO's name for Chipotle now is Brian Nicole.
Yeah,
That's the
Brian
guy.
Nicole. Yeah, that slipped my mind.
You
Yeah,
know,
he's been doing a great job.
Yeah.
And we have AAA in our portfolio as well.
Great. I'm going to move on to China. Something that I know you're invested in. I think one of the latest articles you touched on was actually JD and Alibaba. So give us your thoughts on, you mentioned very early on in the podcast that you invest in companies where countries actually, where it's listed where countries actually respect the rule of law. And I think in China, with the recent, clampdowns, obviously there's a lot of nuances, which I'd like to hear your thoughts on. And what are the risks in China and how do you mitigate them investing in China?
Yeah, that's a great question. I personally, I don't spend a lot of time looking at macro picture, but when it comes to China, you do have to look at what's going on in the country. And China is a very unique case in that Xi Jinping and the Chinese Communist Party has been putting a lot of different regulations in place and trying to make it more into a country that doesn't focus on corporate profits, and he's trying to encourage more of a social aspect to businesses, and that can hinder businesses in terms of maximizing profits, etc. So a lot of people have been staying away from China, and I think rightly so because of all the regulatory risks involved. Right, at any point in time, Xi Jinping and the country can create new regulations that make it harder for a company to make profits, especially if you see in the education sector in China. And there has been not just the education sector, the insurance industries, the tech industries have all taken a hit because of some regulations that have been put in place for them. So I think from that perspective, if you look at it and that risk of new regulations coming in, China is going to become much more difficult to invest in. But if you look at Tencent's recent results, they have had a hit to their margins this year. Revenue went up, but margins decreased. There's some structural change in the business, but I think Tencent's. I think Ponima was saying that. CEO Ponima was saying that if he thinks that it's for the good of over the long term for sustainable growth, So it remains to be seen. I mean, if China does, or if the China government doesn't impose too heavy regulations and allows for the tech sector or the companies to keep on growing and not hinder them too much, I think it can still be an investable space. China can still be an investable space. We do hold some Chinese companies in our portfolio, like Tencent and Meituan. But I think you have to be mindful of the risk. And so for us, we are happy with having I would say like a under 10% portfolio exposure to China. And we don't have too much, China has a good rule of law, but the law can change, and the law changes and regulations. So that's something to be mindful of. We do think about.
Yeah, probably just one nuance deeper with regards to China. So this is going around, especially in the so some retail investors who may not be understanding the nuance too much, but for those who understand, there's always this debate about variable VIE structures of Chinese companies, and then ADRs, American Depository Receipts, that you buy. So they say that if you buy, there's this general thought process that if you buy the Alibaba listed in Hong Kong, it's much safer than buying the ADR in US. And probably help me refute this, or help me agree with this. What are your thoughts on it? Because there's many school of thoughts, and I want the listeners to hear both sides of the story. I'm neutral about it. I'm not too comfortable with the VIE structure, but obviously there are proponents and there are also opponents. So maybe can you share your thoughts about it?
Yeah. So from my understanding, if you invest in, and correct me if I'm wrong, but if you invest in the Hong Kong listed stocks, right? So if you invest in the US listed stocks of ADR, so ADRs of China companies, you're actually listed. You actually have a economic interest in a VIE entity or a variable interest entity that's listed that is structured in the Cayman Islands that has an economic interest in the China company.
Correct.
So that's a convoluted structure. And actually, if you invest in the Hong Kong, so Alibaba has two, right? So it has one that's listed in the US and one that's listed in Hong Kong. So if you invest in the one that's listed in Hong Kong, you are also getting the economic interest of the VIE in Caymans or whatever country that this entity is structured at. Then eventually so they still have that convoluted structure. But the risk of American ADRs or US listed companies is the delisting risk that China is threatening to force all companies to delist in the US. So that's the risk there. I think Hong Kong has less of a risk. So the Alibaba stocks are not facing delisting pressures there. And I don't know whether the delisting risk will materialize. And I think there's a low. I mean, I can't say for sure. But that's the main risk. But in terms of the structure, I think they're very similar structure in terms of Hong Kong and the US listed ones. They both go through the VIE.
Okay. Yeah. Because when I was reading and studying it, right, I'm like, my God, if a retail investor who just beginning to touch water and to understand this, right? If, even financial statements they already finding a struggle, and then here they are, pop. Here's another interesting structure for you to study, right?
Yeah, you guys are talking about VIE. Sorry, I had to head off just now a little bit, but it's about the VIE structure, right? Are you guys talking about that?
Yeah. I was asking Jeremy because I started off the question with China in the context of the rule of law. And then I nuance it a little bit deeper to try to say, if we are buying into it, is that how is it pertinent? And this is actually leading to the next question. Is it pertinent for the retail investor to really, really understand it deeply, or we just trust that the governance, either through SEC, either through the Hong Kong Stock Exchange or Shenzhen Stock Exchange, will not simply pull the plug, the delisting just unnecessarily. I think that's the question, the final question I want to ask Jeremy on this.
Yeah, so we wouldn't know that. Everybody's worried about the risk. So I think that the risk is small. I think recently the Chinese government has come out to give a little bit of confidence that they will want to support this structure, the VIE structure. I think it was a couple of weeks ago, and then some of the share prices, the VIE structure. So some of the share prices of these companies actually shot up. I think the China companies. So if you notice, I think like Tencent went up like 20% or 25% on a single day, Meituan as well.
Yeah, man. Yeah.
Yeah, so I think there's a lot of incentive for the Chinese government to support this, give investors confidence to continue to put money into China. But yeah, you won't know what will happen. Is like they're willing to just put a plug on the education sector. So, So you have to.
I have a comparison. I don't know whether this is the right comparison, but at least on the surface, it seems to me to be that way. And I know you've also looked at Amazon before. So happened they're in the same industry with I would say, somewhat similar conditions in that the whole idea, the whole principle of the VIE structure is that it gives give foreign shareholders economic rights, but not governance rights. That's the whole principle, right? You get the dividends, you get all that, but you don't get a say. Similarly for Amazon, though it's not a like for like, from my understanding, correct me if I'm wrong, Jeff Bezos doesn't own like that much shares of Amazon, but yet his governance rights as a percentage is actually a lot higher than his actual shares. Am I right to say that? Are you aware of that?
Yeah, so a lot of tech companies have dual share classes. So they have share class A, share class B, and the ones that are open to the public are usually like the share class that has lower voting rights. So the ones that have high voting rights are reserved for the insiders or the CEOs and management team directors, and that gives them the voting power. So most of them, like if they decide to go with a dual share class, then they want to hold the power, the voting power. I think the VIE structure, besides the governance, there's also the risk that China may just completely say, "Oh, this VIE structure is illegitimate," right? And then you don't even get the economy rights to the dividends to the company. So that's the risk that people are taking. So I mean, we do own Hong Kong listed shares which go through the same route, but which I think the risk is small for that.
Great. I'm moving on to the last two main themes that I want to get from you, and probably the first one, it's actually about portfolio strategy. I know you did allude to some during the podcast, which is like now you hold roughly 40 to 50 on average. Your highest 4, 2, and 1. Am I correct? 4%, 2%, and 1%.
So we started with 4%, 2%, 4%, 2.5%, 2%, and 1%. Yeah, but now it's all over the place. So
Okay. So maybe there's this article you wrote on the 3 portfolio management strategies that you wanted to adopt, and mind the size, manage the risk. But the interesting one that I wanted to probably dig deeper was keeping cash in hand. And you said that you usually keep about 5% total capital, invested capital as cash. When was the last time that you fully deployed it? And do you think that once the market rebounds, what is the pivoting moment that you will still puts you back on a position where you hold that 5% in cash again?
Okay. Actually, I don't remember writing the 5% in cash. But we actually haven't been holding cash for our fund. So as an equity fund, we plan to be fully invested. If you want to hold cash, our investors tend to hold some cash, right? So when the stock market is down, then they can put their cash in our equity fund. So to them, the fund is like the equity exposure. But if you're managing your own portfolio, it might be a very different style of investing, right? You might want to hold some cash in case there's a bear market, but we don't hold cash because we don't want to time the market as well. Even as a retail investor, last time I hold very little cash, and I try to be fully invested because I don't want to time the market, because you don't want to miss out on a good day, right? You don't want to miss out on a bull run. And if you look at historically, it's a bull market, it's like a 100-year bull market, right? So I mean, like over long term, stocks have been going up for over the last 100 years or so, or since the start of recording history for S&P. So if you're holding cash, you're just missing out on that. So of course, there are periods are down, like maybe 10. Like I think the Great Depression had like 20 years where stocks went below their all-time highs and took so long to recover. but it took like 15-20 years to recover. But most of the times the bear markets are short, and like you can recover within the next few years. So for me, I think holding cash is kind of in the long term it will be detrimental to a portfolio. But if you can get lucky and then just deploy the cash at a lower price point, then that would be good. I mean, that would be just a good luck for you.
Yeah.
But for me, it's hard for us. For us, it's hard to time it. So we try not to hold cash, and unless we find no opportunity in the market. So if there's no opportunity in the market, then we'll maybe liquidate some and hold some cash. But so far, searching eyes, we hold very little cash.
Great.
I have a follow-up to that actually.
Please,
How do
MJ.
you, for yourself personally and also with surging, how do you handle, so I mean, if you have so low cash, right, I mean, it's just statistically more likely that your volatility should be higher than, it should be higher than if you didn't, or than if you did hold cash rather. And also you have outside investors, right? So when volatility happens, like maybe early this year, how do you handle yourselves and how do you handle outside investors?
So volatility is going to be an issue in the fund. I think it's going to be a big issue. I mean, not a big issue, but it's definitely going to come up now and then, right? Because volatility, especially when you are fully invested and you don't hold cash. So if you hold cash, there's always going to be that buffer to protect you against some volatility. But if you're fully invested, there's going to be much more volatility, much more bigger drawdowns. So the way we deal with it is basically, as a person, as an investor myself, I'm very prepared for volatility. I know that I expect volatility. I prepare myself mentally that there's going to be volatility. If interest rates go up, stocks are going to come down for the time being before when interest rates go back down, and then stocks will go back up. So I'm mentally prepared for volatility. But I think the key thing is to make sure that anybody who invests in the fund, we prepare them for the volatility. We prepare them that this is our strategy. We don't hold cash. Our fund is going to be volatile. There's no cash buffer to buffer us against volatility. You have to be prepared for that. And investors need to know and need to have the same framework of thinking as us and same investing philosophy as us before they invest in the fund. So before we accept any investors, we explain to them. We don't make them read, but we encourage them to read our owner's manual. Let them know how we invest. Make sure, which we describe very clearly, that how our investing style is. That if there's a stock market is down, we expect to be down as well, and we expect to be equally volatile or even more volatile, considering the kind of strategies that we employ. So I think it's about preparing both ourselves and our investors, and making sure that everybody has the right mental framework and mental preparedness to overcome such situations as is happening now, right, with growth stocks.
Yeah. Have you been questioned by your potential investors about the owner's manual or not? Did they say, "Hiya, ane chi cha me ane in Hokkien they say, wow, so many criteria or whatever." Has that happened?
Not really, actually. A lot of people have, if they don't like our owner's manual, they won't invest with us. If they like the style, if they read it and they say, yeah, this is something we agree with, something that the philosophy that we share, then they'll be happy to chat with us more. So the response to the manual has been good. A lot of people think that it's very good. I don't know if you read it before, but people
we'd love a
think
copy
that
actually,
Yeah. We don't have a printed copy, but we have a soft copy on the online. So people, it gives them a good idea of how our style, how we think, and it just prepares them. We want all investors to be mentally prepared for investing with us.
Yeah, great. I just have one last question before all good things need to come to an end. But I have one. But before that, MJ, do you have any questions?
Yeah, actually just
Jeremy?
one last. I've been waiting since the beginning to ask this, but I know I can only ask this right at the end because start some fire right at the beginning, right? But I believe this is the most controversial question. I look forward to your answer and perhaps some of the response for the Kairos people. So obviously Surging is your partner, right? And obviously if he's your partner, there are a lot of things that you all see eye to eye with, the way you invest, the way you do things, all that. But are there things that you guys disagree on? Do you guys have different opinions? You can either say, it can be anything, right? Because it doesn't have to be investing related, the way you see the world and all that, or maybe a particular stock in the past that you've looked at, or even currently where you're like, he thinks it's A, you think it's not A.
Yeah, that's a good one. For now, I think we are very much aligned, right? The way we invest. I think in the past he's invested in many different stocks that I've not invested in. At the time, maybe I was thinking like invest in Netflix. I was thinking like a lousy company, I was thinking how much? I mean, content is so expensive, how can it become cash flow positive? But yeah, I've actually grown to think differently about Netflix. So actually he's kind of influenced me in the sense. And yeah, but right now, looking at the investments that we make, we do discuss about stocks on a daily basis, me and Searching, and come up with new ideas. A lot of the times we do come up with the same conclusion about a stock. So even though we do our research separately, we do come up with the same conclusion. But sometimes some stocks we may have slightly different opinions in terms of valuation, in terms of, so we sometimes discuss that and I'll bring it up to him. And we do bounce ideas, and then he will take that into account as well. So, but ultimately, this our working relationship is very good. So me and Searching is a portfolio manager. I'm the analyst. So we discuss stocks, but Searching is the one who makes all the portfolio decisions, and I trust him completely to make the final decision on the investment portfolio. So I would say that because of that trust, I'm able to leave it up to him and sleep well at night. And a lot of things I do agree with him. So there's not a challenge for me to. We don't like fight. I want this stock in the portfolio, or, or I don't. Why do you invest in this one? So it just doesn't happen so far. But if I feel strongly about it, we will discuss.
All right.
Yeah, great. Any more?
No, I'm good. On to you.
Yeah. So probably the last one, and I think more. This one is definitely for the audience. We have quite a unique demographics, Jeremy. So maybe just for your context and understanding, we started this channel with trying to help the 20 to 30 year olds because we knew how hard it was to get quality content and to get there's a lot of information, but how do you nuance it and consolidate this information? So maybe an advice to someone who was new to your field, and I thought this was very pertinent to you because you an MBBS graduate, trying to find your way. Thank God you had your neighbor in a way. Thank God you bumped into Surging. So what would you advise a young, let's say anyone, MBBS ka, JD ka, Bachelors of Law degree, it's so happened that, it's so ironic. This morning, my brother-in-law called me at 7 in the morning, 7:30. I haven't even told MJ this, asking me about stocks. So I got a bit shocked. So
give me another Jeremy, 20 minutes. I'll wake up. Just
yeah. So maybe, Jeremy, how would you advise someone who is fresh about to take his or her foot into this, either being an active manager or either taking charge of their own stock portfolio? What would be a good starting point, and how you advise them to slog on or continue?
I think if you are just coming out of uni and you are starting to get money, savings, and you want to manage your own investment portfolio, I think it's important to start early. But you have to read and you have to understand the stock market before starting. So I mentioned the book 1 Hour Wall Street that that's a good book to start with the investing basics. That will give you the general knowledge on what is the stock, so what to look for in the stock, and then after that you have to read up. I think it's important to just read up as much as you can about stocks in general. And there's so many good Substacks. There's so many good investment websites like Motley Fool, Seeking Alpha, and just look at company results, company presentations, even starting with the most basic ones like REITs. I think that gives you a good stepping stone on what to look at. And they have good presentation slides, and then you can just Google the terms, that will give you a good idea of how to start. And managing your own portfolio, I think either you do it the hard way, which is do it yourself, or you and just keep reading and understanding, or you can just invest in ETFs. And for those people who want to do it professionally, I think you just have to read, and then hopefully you get a lucky break like me, or if you can. I think a good place to get your name out there is to actually write blogs. Start off with creating content out, and hopefully gaining some traction. So I know of some young guys who started really good blogs. I can't remember off the top of my head, but it's just like it also kind of crystallizes your thoughts and gets your name out there. And I know of people who have hired because they like the blogger. So they like the blogger and they hired the guy. So so it can be a good place to start. But
Great.
I mean, it's a lot of work. So you guys, as content creators like yourself, do a lot of hard work.
Yeah.
Yeah, but we talk
Thanks.
only lah. That's the thing lah. We don't write. Maybe you should write more lah. Joe.
Right is
We just talk
another
only.
level altogether, man. Yeah.
No need sauce one when
Yeah.
you talk, sometimes.
Yeah.
Yeah. Continue. Yep.
Yeah. So probably the last one is if you want to be found. That is if you want to be found, where can people find you? I know you mentioned to me your LinkedIn profile was kind of outdated because you're still an analyst at Galilee Investment Management.
Oh, actually, that's my current job, Because Galilee is the fund manager of Compounder Fund.
I see.
Okay, I remember now. Yep.
Correct. Yeah. Because
So
you need that to write on the entity. Yeah, I remember Serging was explaining this to me. Okay.
Yeah.
So if you want to be found, where can people find you actually?
So you can find us on the goodinvestors.sg. There's a blog that me and Serging share our thoughts on. And we also, if you subscribe to our newsletter, we'll give you an email on every week on some of the Serging will write up on some of the articles that he read that week. So it's quite interesting. He reads a lot, and it's a good summary of some stuff. And also you can find us on compounderfund.com. Yeah.
Okay.
That's where we write our thesis on the companies that we invested in.
And you also have your owner's manual there, my guess.
Yes, we have our owner's manual.
Great. Thank you.
But
yeah.
So our fund is actually only for accredited investors only. So just as a disclaimer.
Yeah, understood. So I think there is, I don't know about in Singapore, but you must have like a certain amount of income or a certain amount of net worth before you are considered an accredited investor before you can invest, right?
Yeah. So, you must have there's a certain criteria for that.
Great. Jeremy, it has been an absolute pleasure. Do you know 2 hours has passed already? Coming to close to 2.
Yeah.
I hope it was fun for you.
Yeah,
I
that
hope
was
it
fun.
Was fun.
It's great to chat with you guys.
Yeah. Jerry still owes us chili crab.
Yeah, we are planning to.
I'm not familiar with all the Cairo guys, by the way. Yeah, I went for Cairo's one or twice, but
So it's a good excuse for you to meet up with them as well. When we
We'll let you know when we're down as well.
Yeah,
soon,
exactly. Soon. Yeah.
Yeah, it'll be nice to catch up in person or get to see you guys in person.
Yeah, for sure.
Now
first
that
April.
now that the Singapore Malaysia is open already.
Yeah, I just realized my passport expired February 2021. So I have to get that sorted out first. All right. Jeremy, it's been an absolute pleasure. MJ, any last words from you?
No, man. I just can't wait to see all of you, including yourself, in person. Finally go to Singapore, you know? It's been a while.
Yeah.
It's been a while.
Jeremy, thank you so much. All the best. Take care and, stay safe.
Yeah, thank you for having me.
Yeah.
See you guys.
See ya.
See you.